COVID was an injection of a lot of liquidity and super cheap borrowing costs. When you have zero interest rate policies, it just leaves room for people to buy. I think the challenge with the conflict in the Middle East is that we finally have felt like inflation was moving the right direction.
We lived above the 50-point index from 2002 to 2024. Here we sit in 2026 with rates below 6% for at least a moment. I think this just means that the environment to buy homes is better than it was last year. Episode 81 of the award-winning Market Moves with Mark and Jeff, two uninteresting guys talking about interesting times. Jeff, I just came back from a fun little spring break trip with the family. We went to South Padre Island, which is a small Texas barrier island right at the tip of the Texas-Mexico border and on the Gulf of America, I guess. It's still strange to see on the maps, but purposely went down for this past weekend because the best guess was that SpaceX was going to be launching a rocket. And we were able to see the facility and the launch pad from our balcony of the hotel room. So that was the plan. Unfortunately, last week, they pushed the launch by some 4 weeks, so we did not get to see a launch. But what an interesting trip that was to Starbase City.
Boy, it'd be awesome to see, Mark. My wife's actually identified that as a desired destination at some point. We've never been. My condolences for not being able to see the launch. What a bummer to make the plans and have it line up with spring break and then gets pushed, although that's the nature of that business, to be sure. But sounded like you could see, look out over, Starbase, or you could basically see it from where you were, right?
We could. Yeah, it's 5 miles away. It was terribly windy all 4 days we were there. And so it was kind of hazy. So you couldn't see it super clear, save for a couple of afternoons. We did make a trip to Starbase, and boy, is that worth the trip. A couple weeks ago, we were talking about, I think, in regards to maybe an artificial intelligence discussion in real estate professionals, kind of the man in the arena. It is really hard to navigate the fear that's out there, the unknown that's out there. But boy, you're in the game trying to make decisions where there are consequences for your decisions. And you just get this sense when you are driving right up to it almost looks like you're on another planet because it's like this very sandy, marshy land. But you have this enormous office building, these rocket launch pads in the middle of nowhere, the Starship main ship being tested off to the side, and you walk right up to them, and so you see these folks out there just kind of building all of this out of nothing. It's both amazing what has been built, and really amazing to see what they're striving to build. Talking about all this, launching these satellites and getting power from the sun and this phenomenon called this Dyson sphere, which is just surrounding the sun with a bunch of solar panel capturing all the energy coming off of it to power all these different things. What a world, man. It's really cool. And for me, maybe lost slightly on my wife, but for me, just kind of in awe of being around the attempt, that we're at a moment in human history where this kind of level of space exploration or utility is possible. So it was really good for me, and I think it ignited a little bit of interest in my kids, which I'm desperately trying to find.
Well, maybe mission accomplished in that regard as well, then, Mark. If the kids are taking up some interest, but that resonates, and to me has parallels in just on multiple levels. It is so hard to compete and to compete effectively, really, in any market. That's been, kind of at the heart of a lot of the things that we've talked about, whether it's real estate or artificial intelligence or other tech-related, aspects. And a lot of people go after things, and it's just not that easy to make things happen, literally. And it's kind of fun. A while back, I'd listened to one of the biographies on Elon, and just hearing about them, getting SpaceX up and going off the ground, out in some forsaken island somewhere, to where they initially had to start launching. But it's literally creating something out of nothing. And there's just a lot of, I think, parallels to trying to bring anything to market, whether it's a product or a service or anywhere in between. It's a lot of fascinating things happening. And I think, he and his companies really kind of personify a lot of what that represents.
I mean, it feels to me, I guess on the surface is a stretch to connect these things, whatever we do in real estate to what they're doing. But, we've talked about the electrician that all of a sudden is getting paid more than the software engineers at some of these remote data center installations. There's a real shortage of electricians, kind of who'd have thunk it. But here we are sitting there. So there's just a lot of unknowns, and you just don't know how the market is going to play out one way or another. And for like SpaceX is, I think the goal was just it costs $100 million to bring a ton of anything into space, launch costs. Let's cut that by a tenth or 90% or whatever it is. And so now that that's been accomplished to some degree, it has now opened up, data centers in space, which was no plan of anybody's, I don't think, at any point in time. And, I tie this into real estate too, in this world of AI. Like, you just don't know where this stuff is going to go. I think most appraisers, you and I are certainly in this camp that are, I think Kevin Heck last week said that it was kind of a pet issue of his to sort of defend the profession's livelihood in the next 5 years, because there's so much doomerism out there. But I think if you just keep improving your systems and processes, you make yourself available for all sorts of opportunities that can come, and most of which you can't predict.
And that's the hard thing is I think everybody wants to have comfort in what is coming, to be able to predict and, hey, and in a sense, have that reliability or predictability that we've talked about that can kind of be an inhibitor to investment and like action taking place in a market. But the reality is the future is unknown, and it's really hard to even predict or anticipate what will come. And yet, like you say, I think being in the game, I think understanding and trying to keep up with the technology as best you can definitely sets you up way better than those who just say, man, I don't want things to change. I just want things to be the way they always were. I think that's human nature, and I certainly am not immune to that to some extent. But I also know that that's not, like the history of humankind, and things are going to evolve, and increasingly it's at a rapid rate. I was at a continuing education conference that was put on by the local chapter of the Appraisal Institute over the weekend, and one of the presenters, guy I know, and like, he did a good job, but he was talking about how to implement artificial intelligence into appraising, and his comment, was basically, look, if this feels overwhelming, if this feels like you're being left behind or don't know where to start, just start and do something. And even if it's elementary, even if it's, feels silly that you may not be as advanced as others that you hear talking about, or as what he was showing in that presentation, being in the game and learning is really the way that you keep up with it. And I think a lot of people don't start for fear of already feeling like they're left behind. And it just, his message, really resonated with me, I think. And you and I have been, kind of thrusting ourselves into, trying things, trying to learn how to implement stuff. And man, it's not easy, and it's certainly humbling, but I think it's the only way to really hope to be competitive going forward.
Yeah, that was the first thought as you were talking about that, Jeff, that comes to mind to me, is the projects that we are kind of deep in the throes of right now, which we'll be talking about on this podcast soon enough. How painstakingly slow and due to our naivete for the most part, and sure, we have folks at our company that don't need to go through this learning curve, but if we just shift all of that to those folks, you and I won't learn to the depths that I think we need to know to really make good decisions in leading a company one way or another. And so, boys, I mean, it's taken 5 days to get some simple public account set up. My gosh, why is it taking this long? I don't know, but these are things that I now, coming 5 weeks into whatever we're working on, say, I feel a thorough understanding of what the foundation that's been set for us to work on some of these AI projects.
100%. And then that was exactly where my mind went as well. And I think that the advice is timely, especially at this point in time, where it's like, it's so tempting to just feel overwhelmed and not do anything. And, doing something, finding something that you've got, an interest in, or at least willing to jump in, makes a real difference. I was on a webinar last week, and they were doing a poll, asking who had used a model versus who had paid for a model. And it was just interesting statistic. I mean, those in the professional space more had used artificial intelligence models than not, but there weren't very many still that had like paid subscriptions yet. And that was a little bit surprising to me in some ways. But man, if you're testing, if you're playing, if you're getting, into it at all, it's the right way to be going forward. And there's certainly setbacks. You learn what it does well, what it doesn't do well. And the hard thing to keep up with is, those answers might change tomorrow with the release of a new model or updates and improvements that are made to it. But if you're not in the game, you are, being left behind if you're like self-selecting out of participation in the first place.
Well, Jeff, this is at its core, and I guess surprising to me and probably you. This is an economic podcast. Never thought I'd be into that. And our tagline leading into each episode is two uninteresting guys talking about interesting times. And these last 6 years have been of some of the most interesting times that the United States markets have seen for sure. And we're recording this on a day before March 13th of 2026. And that is notable because on March 13th, both March 13ths in 2020, in 2026, we're Friday the 13th. I'm probably some not coincidence, I guess, in the simulation that we're in or whatever. But March 13th of 2020 was 2 days after COVID was declared a pandemic. And the markets on that Friday were down. And Jeff, we just got a note or a graphic here showing Google down 10%, Apple 12.5%, Berkshire Hathaway 11%, Amazon 8%. It was a bloodbath in the public markets on March 13th in 2020. This was the worst day the Dow had seen since an October date in 1987, known as Black Friday. And I kind of remember back, this was an interesting time in you and I's careers, and talking a little bit about that day and then what has gone on in this marketplace since then. I thought it would be an interesting time to check in and see where we are here and what we have been, what we've gone through.
Yeah, it's we did last year kind of a mid-year like review and then some projections and then kind of same thing, at the beginning of this year. But to look back the beginning of the decade, man, it's actually brought back some interesting recollections and even emotions of this uncertainty. I remember very vividly December of 2019 and into January, February, hearing about the first cases of COVID showing up in other countries and thinking, it's kind of weird, there have been bird flus, there have been other things, right? But then, to see it spread and really literally become a worldwide pandemic, on the heels of starting into kind of or pivoting into a business venture, it's like, holy crap, where is this going to lead? And I fully expected that it was going to lead to like stagnation in the housing market, drop in home prices, and like a lot of pain and suffering. I was thinking, I hope that we can weather this. The last thing in the world I expected was, what actually transpired in the last, now 6 years, coming out of that event, Mark. But it's been interesting to think back on, what you expected to happen versus what, actually has played out in the wake of it.
It is really hard to remember what the market was like in January of 2020 or December before COVID was an impact. And this was a time we were several years into the cash buyer problem. There was limited inventory, has been limited inventory for a long time leading up to January of 2020. And you like we had all these corporate buyers that had entered the market a decade ago, and you kind of, if you're a first-time home buyer, you needed cash, you didn't have it, and you were competing against cash offers. And so it was a really difficult time to buy. And I remember that because we were in the process of launching our company, no thought of COVID at all. And, the market was just kind of so-so at the time, right? There was not a lot of certainty of change in whatever was happening in January of 2020. And so I remember those scenarios vividly. So on this day, March 13th of 2020, the Dow Jones, when it dropped 10.5%, dropped to 21,000. I am just shocked that from there to today, we are at 46,700, almost 47,000, and over 100% gain. Jeff, we've got housing that went up 50 or 60%, has dropped maybe a little bit on a national average from that moment. And we have home affordability that has doubled in this time. Just a whole slew of data points there that certainly were not predictable by me. I don't think you either.
I wish that I was bright enough to have predicted that, Mark, and I would have invested a lot differently, over that period of time, especially as things were just taking a dive on, that Friday, that we referenced where everything was down 10%. Man, who in the world would have thought that it was going to double or more? And certainly certain stocks, have done, even, way more than that. It was interesting. I was talking to a friend who had said that, she listened to some of the first parts of the podcast, but then as we get into like the nerdy stuff, she kind of checks out. But, it really does come full circle in my mind with some of the topics that we've been discussing. And not the least of which, what we talked last week with Kevin Hecht about was this credit creation, and particularly when credit is given to, for the purchase of assets, it just has the effect of driving up the asset price without necessarily bringing in, additional productive goods and services into the economy. And boy, as you highlight where the stock market was in March of 2020 versus where it's at today, when we look up home prices, same thing. And what's happened in between in response to COVID was an injection of a lot of liquidity and super cheap borrowing costs when you have zero interest rate policies and 2 and 3% mortgage interest rates. It just leaves room for people to buy. And there was a desire, I think, to get out of the big cities, to distance somewhat as a result of COVID and what was happening at the time. But man, the exact opposite ended up happening of what I was afraid was going to happen. And that was that a lot of people wanted to buy. They wanted to buy something different. They're working from home or quarantining at home or whatever. And so, well, gee, I want my home living space to be as optimal and ideal as possible. And so a lot of people bought, a lot of people invested in, their home space if they weren't just buying a new one. And that fueled by super cheap interest rates and kind of abundant credit to go after it has really driven up the pricing to the point where we look at today and say, man, I never would have expected in a 6-year period of time things to have changed that dramatically.
Yeah, Jeff, I've heard this like philosophy. It's time in the market instead of timing of the market, right? And I remember in 2019 having conversations with my wife of thinking I knew a lot. I'm a smart real estate guy, which I'm clearly not. I mean, I'm not an investor in real estate. I just kind of report on what happened. I can do that pretty accurately. But I had thought about selling because my home had gone up a little bit in value, but I didn't think that it would have held. And so we thought about renting for a year. And, I would have lost out on that 60% appreciation that took place just, probably 6 months after this idea that I had that was just an awful idea. And being in the market is important there in housing and stocks, wherever, and I think I hear in stock market, something like 15 days out of the last 20 years are really where all the appreciation has happened, like this kind of thing. Right. And so I don't know, it's in what's happened as affordability has gone away, right? We've doubled the cost of a mortgage between price appreciation and interest rate appreciation. You've got this home buyer phenomenon, first-time home buyer age going from low 30s to over 40. And so you've locked out this enormous group. And I think this look back from March of 2020 to March today it ties together a lot of themes that we discuss on this show. There has been a lot of dramatic change in this sort of cruel psychological experiment that has been conducted on the American home buyer in the name of sound federal monetary policy to protect us from collapse. And Mr. Hecht was supportive of what the Fed had done over the last bit, during this COVID period. I think a lot of people view it that way. Could we have shut down the economy if we didn't know that the Fed was there to backstop it in that way. I don't think we should have shut down the economy the way we should. I feel pretty strongly about that. And so I'm anxious for a world where the Fed gets out of the way and we sort of, especially as it revolves around real estate, that we just sort of let things be more normal and more certain.
Well, there's value to that, and increasingly, that's what you hear investors and business owners wanting, is that kind of predictability and reliability as far as economic and financial policy perspective. Of course, we led out the show talking about how unpredictable the future is, and I think that both of those things can be true. That if you have reliability from a policy and a political perspective, artificial intelligence is still there and evolving and is going to impact the way that things play out. But boy, it's sure hard to make decisions, whether as an individual or as a business owner regarding business investment, if you don't know whether tomorrow's tax policy is going to look a lot different, whether the interest rate and lending environment is going to look a lot different, if the tariff rate and environment is going to look a lot different. There are just so many things that are within, our control collectively that, getting back to stability definitely eases the path forward for like the moving forward of business and just decisions that need to be made that are a lot harder to make when you don't feel very good about what the future, what decisions might be made that impact you and in your decisions to be made.
Jeff, the second bloodbath chart we have is just today, March 12th. I think the lesson here is get out of the market on Friday the 13th in March. I think we've lost 600 billion in market cap today. I'm sure that will correct in the afternoon. We have these wild swings in oil prices that seem to be happening over the last several days. We have this Iran war, and that is probably already making its way to real estate right now. Energy prices generally are impact all. We see it impacting our appraisal business, in ways as we visit properties and that sort of thing. But it's just continued uncertainty. I hope we find some of which, but I think it's producing a little bit of a cooling, Jeff. And I wonder if it's war related for sure, but the subsequent energy prices. But I think it's also waiting for this Fed chair to come in, a promise of things being better soon enough.
Exactly right, and I think the challenge with the conflict in the Middle East is that we finally have felt like inflation was moving the right direction. In fact, there was a recent print that was put out that it was holding steady, moving the right direction, generally towards the Fed's 2% target. And then all of a sudden you throw this conflict in, and it's not, the oil prices aren't showing up in inflation data yet. And it just is going to depend on whether this conflict is resolved quickly or not. But in the short term, there is a real shock to the oil supply. It's driven up the cost of oil. I've seen it spike as high as $120 a barrel, which is like almost a doubling of where it was at. Previously, it's not stayed there necessarily, but up around $100 a barrel is where it has been the last couple of days. And if that's a short-term shock to the system, I think that we probably move forward without too much impact. But the stage was really being set for the new Fed chairman to come in, make whatever change he's going to make, and then just let things sit for a while. I worry that inflation prints between now and when he is installed may start to reflect the issues, all stemming from the conflict in the Middle East. And if that gets prolonged and drug on, I heard it in an article recently, people talking about, well, geez, could it go as high as $150 or $200 a barrel? It hasn't, and hopefully it doesn't, but it wasn't an option that was off the table as far as the overall supply. There's an interesting chart that I didn't pull up for this, Mark, but it showed, I think I sent it to you at one point, the supply of oil from different countries or even continents around the world. And the Middle East accounted for just over 30% of oil production, which is significant to be sure. I was surprised that the United States accounted for about that much as well. It was 32% or something like that. And I mean, I've seen reporting recently that's talked about, the U.S. being impacted, but not as much as those that are more heavily dependent on oil imports because they don't have any domestic production as an option. These things just add so much uncertainty into the market, into interest rates, and where policy can go as a result of what the downstream effects might be. So I'm hoping for a quick resolution for a lot of reasons, but selfishly, part of that is a hope to maintain the policy of interest rates getting better and maybe more sustainable as we look forward into 26 and beyond.
Yeah, I sure hope so. We are rates dropped, Jeff, below 6% for about a week, maybe a little longer. I think we had a bit of an uptick in activity during that time, but here we are in the throes of the best spring month in March, and I think we do have a little bit of cooling. This, to me, was anticipated to not be an incredibly strong spring because we are waiting for the May Fed news. We've got a nominee, we've got to get a confirmation, and then we have to get a meeting and see what all the Fed governors kind of conclude one way or another. But I right now I expect a meaningful drop. Inflation concerns certainly there. I think jobless claims are going to help the case for mortgage drops. And we've talked about this a lot, but I think Trump's opinion and anyone that he interviewed had to have this opinion. And I think they would come by it organically. I don't think they would have the opinion because Trump had it. It was just a qualifier that no matter, rates should just be lower than they are. And I think that is going to be the position held for a whole lot of reasons. So I think we'll see that, but we are going to be in this cooling down period for another 3 months, in my estimation, and we're seeing this, and we've got a few charts to talk about it, but we're seeing this cooling in not an overheated market by any stretch, in one that is desperately wanting to get hot, or there's really no room to go but hotter because it's so ice cold. But that's kind of where we are. So this first one, Jeff, is the housing demand. Yeah, this one is just so interesting. It goes all the way back to 2002, but the normal demand index is 50 points here. And in this chart, we're down I think we're at the 6, maybe we bumped up to the 9 out of 100 when 50 is normal. So we are just we lived above the 50-point index from 2002 to 2024. And since then, Jeff, it's just been rock bottom, and here we sit in 2026 with rates below 6% for at least a moment.
Yeah, exactly, and again, this looks back. This actually goes back beyond the obviously the beginning of 2020, and it just continues to, I think, paint the perspective of where things are at, from a historical perspective. And the thing that blows my mind, Mark, is that we talked about the escalation in asset pricing and in home pricing, and yet that certainly hasn't translated into like overall transaction volume. We're still at such historic lows of people buying and selling in the last couple of years, in spite of the record highs, and probably in part because of them, and this lock-in effect that we certainly talked a lot about. But it's these, you and I are kind of nerd out on this stuff, but these charts that give some of the historical perspective really are insightful, because it's so easy to just live in what we see and know day to day. But the good reminder of like how much room I think just organically and naturally there is for transactions to come up beyond where they're at today.
So the next chart, and thanks to Reventure for that prior chart here. Here's a Housing Wire chart that is describing 2024, 2025, and so far 2026 to date weekly pending sales. And what's notable to me is we are kind of right on track with the last 2 years. The last 2 years sucked, Jeff. And here we are right on track. I will say that I remember vividly February, March, and April being, I was excited because we were seeing quite a bit more activity. At least it felt like we were. And that came to a screeching halt with whatever the freeze and the great holds that are out there for better news coming. I remember when it used to be survive till 2025, which seemed like a ridiculous statement. If that actually was the case, look out. And here we are in 2026, and I mean, we're just kind of right where the last 2 years were.
Yeah, tracking for a crappy trajectory is hard to get very excited about. And it just seems like we've been on the cusp for, the last couple of years, really, of some good news coming, or at least an overcoming of the shock to the system that was going from 2 to 3% interest rates to 7 to 8% interest rates in a very short amount of time. That just slammed the brakes on everything. And so as we've slowly been trending back to 6, and as you mentioned, dropping beneath 6% for just a second, we see a meaningful, or at least a measurable uptick in transactions. I mean, I know that there are people on the sidelines wanting to buy and sell, and it just doesn't make sense, at current interest rates, but it doesn't. I definitely keep getting the sense that it's not going to take a lot more movement for them to come off of the sidelines. March is historically a busy time, so I mean, great that volumes are up today over what they were maybe in February or January, but yeah, as you laid that out, it was hard to get very excited about tracking for another historically low and kind of crappy volume environment.
Well, the next chart, Jeff, I'm thinking to myself here that I probably need a little bit more definition to the mortgage purchase application index. But good news, it is a meaningful uptick above the 2025 mortgage purchase application index. And I think this just means that the environment to buy homes is better than it was last year. It doesn't mean that we're getting a lot more pending activity, but the environment to get more activity is better. Is that how you read this?
It is, and I think the other aspect to what we're seeing here, and this does, impact appraisers and mortgage loan officers, is for the mortgage purchase applications. I think it's setting the stage for people kind of coming out of hibernation, maybe a little bit, and again, interest rates today are better than they were 12 months ago at this time. And so I think that any drop in the rates, does kind of help drive or spike this. What we don't have is an overlay of what interest rates were at the same time period. And I think that's probably, what accounts for it here. Initially, when I looked at it, Mark, I was thinking that, maybe refis were factored in there. And we are seeing more refinance transactions than we were a year ago for sure. But with the way that Housing Wire's labeled this, I think it is for purchases, specifically. But it just highlights the rate sensitivity that exists in the market right now, and has for a long time, I guess.
Yeah, that is it. And I think what's hurting us more than a lot of people acknowledge from the macro headlines is that this rate uncertainty, or a promise of it being better soon, is killing it just keeps the fence sitters on the fence, and we see these peaks because there's a little bit of good news finally hits, in a few of the fence sitters that can't sit any longer act. But I think we're sitting here waiting now. The transition into a little bit of we've got 3 more topics to be covering here, and they are dealing with a little bit of what I see as an anticipation of a better cycle in real estate, Jeff. So we've got some reattempts at disruption in the real estate space. I'm pausing here because I think you might have another chart to jump on. I'm wanting to get into build to rent. This might be a nice transition, but let me turn it over to you before I take us too far astray.
Yeah, no, you're no problem at all, Mark. I actually was just setting the stage for if we get to a few of these other slides, but yeah, I think with where you're going on the build to rent, boy, there's been some interesting developments on that front. From the Trump administration coming out and saying, we're not going to allow institutional investors to own a certain number of properties or beyond that, but others, kind of making the case that hey, housing is housing, and buyers and renters both have housing needs in the market. So yeah, I'd happy to get your perspective on that before we go anywhere else, Mark.
Yeah, Jeff, the story in my mind right now is the kind of housing policy. Trump, one of the kind of bold initiatives that were announced in January was this preventing large homeowners or corporations from competing against the American home buyer in precluding them from buying homes. So the institutions keeping them out. And so we have this housing bill that's kind of being considered by Congress. And it seems that there is a build to rent component. I think it's a small component, but they've kind of said that this bill is past the draft, meaning there's not really expected to be a lot of edits. But it is saying that if you own more than 350 homes or something like that, that you must dispossess any home that you build for rent, build and then lease it within 7 years. And, build to rent is a meaningful, small, but meaningful component of new inventory being added to the market. And, I'm concerned about that. I think build to rent should be left alone as it relates to institutions buying homes, right? I think it's kind of a surprising phenomenon, but in a world where we likely need more housing inventory and supply, these guys are finding incentive to put that out there. So I'm hopeful that they find a way to strike that like mandatory dispossess in 7-year clause from the bill.
Yeah, and there's an interesting aspect to that, Mark, in that if you don't have single family homes as an option to be rented, then anybody in the rental pool is then limited to multifamily apartment housing, something other than that. And I understand the intention of wanting to make as much single family inventory available to individual buyers as possible. That makes sense, and I think is well intended. But I've been interested to see too, we've had an opportunity to participate at least in some valuation projects of kind of build to rent subdivisions or conglomeration of just homes in a metropolitan area or something. And there's maybe more of that than I would have thought that's out there on the one hand, but on the other, I don't think it's competing with 30 or 40 or 50% of the inventory that's out there, or buyers looking to buy competing at that level against institutional owners. And so requiring the dispossession after 7 years, I'm sure is not I'm sure it has opposition. You've got businesses that have built a model around building, owning, and holding long-term and renting. And if they were going to build something to rent and it wasn't single family, I suspect a lot of those would be building something, a different housing product type, apartments, townhomes, or something like that they still plan to own and rent. So I don't know that those units, just because they exist, would automatically be available for individuals to buy in the first place, or that they would be like limited inventory. I think they'd probably just be different, housing types that these businesses were building anyway, because that is their business model.
I remember, boy, I'm trying to think of who the builder was in Texas. This was a 2009 pivot from the great financial crisis when demand just dried up, and they were home builders. They actually were in the act of building some subdivisions with no buying demand at all, and just decided to convert to build to rent, and that happened to go quite well. And so they moved into that business and added a lot of inventory in the Texas area for better or worse. So yeah, I hope that speaking of certainty, they just have none. How do you do anything? Maybe you complete a project that you've already started, but how do you jump into one until you have clarity on what the situation? Because if they are forced to dispossess, I don't think they're getting into this business any deeper.
And one of the unintended consequences may be a lack of available, like at least rental units. If that's ultimately what ends up happening, if it drives them out of the market, for building single family homes. So yeah, interesting. A lot of these things have unintended consequences, and that could be one of them.
Yeah. Well, Jeff, because we seem to be on the precipice of a better cycle finally. I think this has been a historically long down cycle in real estate, given the interest rates. I'm starting to see disruption. We've been covering Open Door quite a bit here, which is sort of boy, if you watch that stock price from 2020 or whenever it ended up going public through a SPAC, high rise, drop to basically worthless. Now a little reinvigorated. Good stuff happening, I think, or good attempts at disruption, but with Better Mortgage, who's also been fairly storied, infamous for their Zoom layoff of 1,000 people. I think that was a little impersonal during the COVID come down, but they have an AI mortgage underwriting announcement and product. I've seen some mortgage brokers out there that are pretty ho-hum to the idea, saying this really isn't much different from what they do. I'm always leery of AI product announcements that maybe just hitting the buzzwords, but not really delivering. I don't know, but they certainly are trying at this, and it feels like mortgage underwriting is one of them. The opportunities for disruption here.
Yeah, it'll be interesting to watch, how that evolves because I'm with you. I mean, anytime you have a buzzword, and especially when it's a company who's, maybe in a fundraising round or, trying to meet, like company metrics from a valuation perspective, it also further calls into question, like the legitimacy of it. But man, it seems a real appetite to be investing in stuff like that. And so, yeah, it does make me wonder for sure. It's maybe an open debate, Mark. I do see some of the silly stuff that comes out of human underwriting. And I wonder if artificial intelligence would either be an improvement in that or a further like regression to, something even worse. I sometimes wonder if there's a human on the other end asking questions that come back to appraisers at times, and if they are, how and where they were trained. But I could see that being an area where, if not fully disrupted, certainly augmented with the ability to just review all of the loan documentation and at least help summarize or get to an answer faster on the underwriting side.
Yeah, I've definitely seen Open Door also be talking about this. This is beyond my expertise, so I really don't know deeply what's involved in that and where the opportunities for AI. But it does seem that many think there is opportunity there, and so it's interesting to see the timing really more than anything. I think that folks are getting a little excited. We've got advancements in AI tools, so there's a deepening of what's possible. And we talked about the Open Door, I think 2 weeks ago, the announcement of a 4.99% mortgage beta. And they've been doing a lot of explaining. This has created quite a buzz on the internet. And I think Open Door came out and explained what they're doing. It is not point buy down. That is specifically not what they're doing. But they're describing that on each loan, you have a par rate. And there is typically, I think it's 350, I want to say basis points, Jeff, but I'm not sure that is the right metric to describe this. But it's essentially a lender markup. And this this is not surprising for anyone to hear. And what Open Door claims is that, well, first, for every 100 of these basis points, it would raise the mortgage rate by about 0.25%. And so 350 typical markup, you'd be at a 0.89% markup. So 5% up to 5.9 or 6%. It's larger now. I think rates are a little higher in the moment, but they're essentially saying, look, this is what the E-Trade model, where people were charging $35 or $70 per trade because that was the business model. Well, E-Trade and now Robinhood and others say, well, I'll make money elsewhere. I just want the traffic of you here making trades. And because I now have the environment for you to do these things, we can offer this for basically little or no markup.
Yeah, that description resonated with me. If that is in fact what they're doing, and I think that it is, it's cutting out the markup for the sake of trying to become the transaction platform or just to pick up market share. And really interesting, Mark, I think probably something we can dive deeper into on understanding exactly how that interest rate is, diced as far as what all goes into it. But if there really is that much room to bring down the interest rate, from just current rates and then not a buy down like you say, boy, it's an interesting prospect. I think that there really could be some disruption, to be had on that front if you're bringing to the market a materially lower mortgage rate than what normally is offered by every other lender out there, just because of the markup that's built into it. There's more to learn, more to come on that, I think.
I think that's right, Jeff. I think that's right. Well, an interesting check-in and look back here at where we are. Market moves started, the last couple of years into this wild time. Maybe part of the reason why we decided to jump into this. A lot of change coming. Enjoy covering it and watching it with you, Jeff.
Boy, I agree with that wholeheartedly, Mark. It's no shortage of interesting things to be covering in spite of us covering them being uninteresting, but it's a good time as always.
Yeah, well, two interesting guys coming from destination interesting times. We'll see you soon.
Very good.